You can start.
Yeah. Good evening to all of you. At the outset, let me extend a hearty welcome to all of you and for having responded to our invitation to attend this particular today's webinar on the recent RBI rate action and the global and India specific macroeconomic issues. And all of you are aware that on the 2nd and 4th May of this month, the MPC committee, the Monetary Policy Committee of the Reserve Bank, met and they unanimously decided that they would enhance the repo rate, and that too by 40 basis points. And also, of course, they had also enhanced the cash reserve ratio by again 50 basis points. Of course, that will again take around 82,000 crores, which is effective from 21st May. So the April policy of the Reserve Bank had indicated also that there are what you call threat to the inflation situation, what is the globally happening, and also the Ukraine and Russia war and other commodity pricing prices heating up, and those macroeconomic issues globally. And also there were the expectation of the Fed going to unwind the accommodative what you call the large quantitative purchases which you used to do, and slowly they didn't want to reduce their balance sheet. So those were there, and RBI also mentioned that the while continuing to be having the accommodative stance, we were also looking at withdrawing the accommodation, in the sense whatever which were done in the 2020 March and May in respect of the COVID-19, it was expected that the Reserve Bank will unwind some of those measures, and which from the liquidity point they had already started. So, but even on the other rate action, so those were there. But this particular MPC committee meeting was out of turn, in the sense generally they meet in a quarterly basis. That is the normal MPC meeting, but this is a out of turn. So the one question will arise, that what necessitated that this particular action resulted in a urgent way or out of turn. And of course, that with the various geopolitical and other reasons, the inflation in the elsewhere like USA or Europe, all have been going very high. So there also they allowed the, even though like US, the target is 200 basis or 2%, but inflation remained almost nearing 8%. So in that respect, these actions were deemed necessary by every central bank. So instead of my major discussing, I would like to have these views from our own panelists, and we have a very galaxy of panelists. They are day and what called every day dealing with this type of macroeconomic issues as well as market operation, and they have the large exposure and experience at their end. So I would like to now introduce our what you call the panel to all of you. Naveen, madam, that your this my slide is visible?
No, sir.
Naveen, just
Share
1 minute. 1 minute.
Yeah.
1 minute. Slide is not visible. Now it is visible, madam?
Yes, sir. Go ahead, sir. Yes.
Yeah. So I am very happy that Mr. Dharmakirti Joshi, he is the chief economist, CRISIL. He has been always our preferred speaker on economic and other macroeconomic factors, as well as the India's domestic economic aspect, and he has been coming and obliging us. So he has been currently a chief economist at CRISIL. He has a vast experience, and he has co-authored book on state finance and various research articles to his credit. And he's the co-chairman of the Economic Affairs Committee of the Bombay Chamber of Commerce. And he's a well-learned person and good academics. And he has attended international training program. And we have Madan Sabnavis, again, a great economist of more than 30 years of experience, even in the corporate sector, and the last more than 12 years in the CARE rating as a chief economist. And recently he has moved to Bank of Baroda, that is in January. And we see every day his articles. Even today there is a business line, I think, or there is one article, and or some other he would say, but that is a very good article, and more than 2,500 articles. And he's also a co-author of 4 books which I have given here: Macroeconomics, Demonstrate, Economics of India, How to Fool All People for All Times, Hits and Misses of Indian Banking. And of course, he's in the various committees. And we have Mr. S.V. Shastri. He's the Deputy Managing Director, Global Markets, State Bank of India. Right from the joining the State Bank from 1985, he has rose from one post to higher, and he had a 34 years of experience. And he is both in India and abroad, worked extensively. And majority, even though he has a lot of field level experience, but the majority is on the treasury aspect. He has held the position of chief dealer of SBI Frankfurt and chief dealer in London. And as a DGM and GM also, he has held the treasury and forex. And as a CGM, he was heading the SBI DFHI, a primary dealer, one of the famous and primary dealer first. And he's the chairman of FIMDA currently and nominee director in same SBI DFHI. And another very towering personality in the sense of knowledge and exposure and being in the treasury area, Jayesh Mehta, managing director, country treasurer, India, Bank of America, a good friend of mine. And he heads the fixed income, currencies and commodities business of the bank. And all the 3 areas are having relevance from the rate action of the RBI. And he is also involved in several market developmental committees. And he was the chairman of the Primary Dealers Association India for a few years. He was the vice chairman of the FIMDA, and he was also for the technical advisory committee on money, forex and government business of the Reserve Bank, and various the financial sector legislative reform commission. He was the subgroup of that, and currently in the various regulatory committees of the regulators. And very young and energetic Harshil Suvarnkar. He is the fund manager of Aditya Birla Sun Life AMC. Again, he has worked earlier in India Bulls, housing finance, again in the particularly treasury and all. And later he joined Aditya Birla, and a very good masters management in studies from Jamanal Bajaj Institute of Management, one of the very best institute, and also post-graduation in securities law from Government of Law College. So with this, yeah, 1 minute. So now I will go back to our discussion. So, yeah. So can I first ask our Dharmakirti Joshi that what may be the reason for this out of turn or whatever, that quick action by the Reserve Bank of India, and what are the various factors globally and domestically had in mind at the Reserve Bank, And what made the difference between the April approach and current approach? And how are these trajectory will likely to move in the future? This is my question, Dharma Dash.
Thank you very much, Dr. Narendra. I hope I am audible.
Yes, sir. Clear.
So, yeah, I think as you rightly pointed out, I think there has in the last two policy moves, a lot has changed. I think when the central bank first announced its policy, sometimes in February, the inflation was expected to decline to 4.5% in 2022-23, with the second half being at 4%. I think that scenario dramatically changed by April, because you got Russia-Ukraine conflict. Inflation anyway was expected to rise, but I think what broke the camel's back was the Russia-Ukraine conflict, and that I think led the central bank to veer towards reducing accommodation in a very clear fashion, I think, and that was they introduced SDF, raised the SDF to suck out liquidity. So it was becoming more clear that they are moving towards removing accommodation formally. I think they were anyway reducing it, but I think it became. But I think now the key question is that what happened between April and the June policy, and why were they what forced central bank's hand to announce a sudden and a sharper than expected rate hike of 40 basis point, and together with that also raise the CRR by 50 basis point. And now I think there are four reasons for why the central bank had to move fast. One is rising inflation. Inflation was rising. I think in April, central bank had raised its inflation outlook to 5.7%. But now I think it was rising much faster than the central bank expected. And it was also getting broad-based. For instance, in 21-22, only fuel and core contributed to 5.5% inflation. But I think in 22-23, as we get into this year, we are finding that all the three engines, whether it is food, it is fuel, or it is core, I think they are moving up simultaneously. So it is a very broad-based inflation scenario, although the demand is weak. But I think when the inflation gets generalized, it becomes very difficult for the central bank to look through it as a supply side phenomena, and they have to act. So that is the movement on the inflation front is one factor which was on the back of their mind. And I think and we are getting inflation numbers tomorrow, I think, for April, and they are expected to be close to 7.5% or maybe higher than that. The second reason, which actually precipitated this decision, was a very aggressive stance from the Fed. I think Fed was telegraphing interest rate hikes, and I think it was almost clear that they're going to raise it by 50 basis point on May 4, and RBI preempted that move. Now I think what happens is India is today, of course, everybody knows it is better placed than 2013 to withstand the such moves by the Fed. It has a stronger forex shield. It has a lower current account deficit. And I think, but it's not insulated. I think because the shock that came in 2013 was much milder compared to what it is happening right now. And Fed is supposed to raise interest rates at least 7 times in this calendar year. So I think and rupee was under weakening pressure, and central bank was trying to address it via use of forex reserves, which actually we have reduced the forex cover from 642 to below 600 billion now. So now I think they had to use the monetary tool as well to address this issue. I think the too much dependence on forex can be risky, and I think you can actually very quickly lose your forex reserves. I mean, if you try to defend the currency too much. So I think this was the other compulsion. The third reason was, which the central bank governor, Mr. Das alluded to, was that inflation expectations were getting unanchored. I think they would like people in the inflation expectations to get anchored around 4%. And I think they seem to be moving. There was a risk that they may move away from that on a long-term basis. And I think both the household as well as business inflation expectations were on the rise. So I think to address that in an inflation targeting framework, I think when you have that framework, you need to anchor inflation expectations properly. So that's the reason number 3. And the fourth reason is that we have already seen consumer price inflation at 6.3% during January to March 2022, which was higher than what RBI had expected earlier. And I think for April to June, they are expecting 6.3%, but it's likely to be much higher than that. So one more quarter of inflation above 6% mark would mean that central bank will have to give an explanation to the government why this has happened. I mean, so I think it's a culmination of all these 4 points, which led to a surprise move by RBI. But I think it was precipitated by, I think, the fear that rupee could weaken further. Anyway, we have been seeing capital outflows from equity markets from October onwards, and I think so that's my take on why the central bank moved. And I think clearly this was a surprise. So it pushed up the bond yields. It was not priced in by the market. So the bond yields are 10-year G-Secs are around 7.4% mark right now. Banks have also announced increase in lending rates, although the lending rates still remain below the pre-COVID levels. But I think the trajectory is pretty clear. And rupee weakened, I think, despite the central bank's move. And I think what we expect is that since Fed is going to continue to raise interest rates throughout the year, I think RBI will also move interest rates, and our expectation is 75 to 100 basis point repo rate hike is possible in this fiscal year, and it will be front loaded. I'm saying front loaded because the move was higher than expected, so I think they'll have to front load their rate hikes. And I think after that, they will watch and how the inflation scenario plays out. I think so. Right now, I think indications are of it getting broad-based. The only bit of good news is that commodity prices have softened a little bit, I think, in the last few days, but I think these are very uncertain times. So let me stop there, Dr. Narendra.
Thank you, Dharmakirti. I will come back on further in the next round to you. And Madan Sabanavis, coming to you. You have been always a little frank and in a way you are watching the whole market action by the RBI regulator everywhere. And I do get a daily report of your research also. So one question is, are the RBI, because there have been some mentioning that the RBI is little behind the curve. So, and also, of course, I don't want you to mention, but what I have found that even in the recent past also, the inflation, even though sometimes expected, honestly, rightly said, someone average, I think it was always nearing that 4 plus 200 basis, that is what you call 6% band. So it was not coming below. So in that respect, are we kept the overall liquidity or in the growth requirement? Of course, that is necessitated when nobody would have thought when the lockdown, all that, at least India needed that. But in the overall thing, how these things look when we look back, and continuing with Mr. Dharmakirti, as your own house, what are the future things shaping up, looking at the global factors? Yes, Madanji.
Yeah, thanks, Narendraji. Now,
Yeah.
actually, I'm totally opposed to this concept of saying that any central bank is behind the curve. I think we take it too lightly. It's a very, very flippant statement to make, because I think the curve is how we define it. I mean, we cannot say that merely because the Federal Reserve is increasing rates or the ECB is raising interest rates, RBI should also be raising interest rates if they're not doing it behind the curve. Because I'm sure there are very, very more intelligent people sitting in the MPC who are actually deciding on interest rates. So therefore, I think I'm against this concept of saying behind the curve. So definitely, I will say the RBI was not behind the curve. And the RBI has been defining the curve all the time. And I think they have also been defining what their trade-offs are. And while the MPC did traditionally have this thing of saying that we need to fight inflation, I think it has changed since the lockdown, where the RBI has been reiterating that it's always been looking now at growth, because trying to control inflation at a cost of growth will not be good for any economy. And right up till the February policy, I think the RBI has also made it very clear that it does not feel that growth is durable enough. So what you said is right. Inflation has always been above 6%. So it's not to say we are living in a low inflation environment, but I think there's a conscious decision taken. And I should think that this is a joint decision taken by the RBI as well as with the government of India, that we need to make sure that until growth is durable, I think that's the concept which they use, the term which they use, that we will have to continue to follow an accommodative policy. Now, quite clearly, we have seen that the way in which inflation has gone up, and I think Dharamkirti has very clearly explained as to how this inflationary expectations and actual inflation, everything has gone up, has caused definitely a lot of scare in the market, because inflation going to 7%, and all of us believe it will probably remain above 7%. And lots of people also believe that even the 7% number is an understatement because of the methodological issues which are there with CPI. It should actually be further higher. I think the RBI has been cognizant of the fact that this number of inflation is more scary than what it looks like. And I think that's why we had this case of this intervention taking place all of a sudden. Now, in economics, we have this theory which says that to make policy effective, there has to be a surprise element. We have seen in the past that whenever you say that, we say that, okay, the RBI is going to increase rates in June, when they actually do it, what do we say? I think all the market people will say that this has already been factored in, and policy tends to be a bit impotent because it doesn't really have much effect. Everything carries on as it is. So I think the whole idea was that you need to surprise the market, and this is what the rational expectations theory talks of. So that's exactly what the RBI has really followed, that let's surprise the market, come up with this thing. And I think the signal has now been sent that we need to be prepared for times when easy money doesn't exist, and we're going to go back to the normal. In terms of liquidity, I have a slightly different view. I think Dharamkirti said that we've had this case of SDF, but to my mind, I think most of the liquidity still exists in the system. Now, I give it to you and you give it back to me tomorrow, the liquidity is very much there. So we need to have something more concrete from which liquidity is taken out permanently from the system. So that's why I think the CRR came into the picture. Because all this time we're saying, okay, there's 5 lakh crores today. I can break it up any way I want to. I can say part of it is reverse repo, part of it is SDF, some of them goes into term reverse repo. But the fact remains that the RBI has created a lot of liquidity, something which all central banks did during the lockdown in the terms of QEs of their own varieties. And we need to get this thing out of the system. So I think this is being done in a calibrated manner. I'm quite sure there could be certain open market operations which would be invoked by the RBI to make sure that you're able to take out the liquidity. See, what they said earlier was that we are stopping the GSAPs, which is to say that we're not going to give additional liquidity. But when I have this 6 to 7 lakh crores, which is there in some form in the system, we need to have that out of the system. I think that is what we are working towards. So that's how I think the CRR the CRR increase is taking place. I won't be surprised if we have further CRR increases, though I would tend to believe that there would be a greater reliance placed on open market operations to ensure that liquidity is taken out from the system. So what does this really mean? We are definitely going to slow down the overall growth process, because it'll be living in denial to say that growth won't be affected, because if monetary policy has to work, I have to slow down the economy. But the whole idea is that we have to slow down the excess demand forces. I have to slow down the growth in credit. If I don't do it, I'll say policy has not really worked. So it's going to have some kind of a marginal impact on growth. Fortunately, I think we started off the year on a very good path. I think all the initial indicators for April, or probably even for May, I think from what the government has said, seems to be fairly sanguine, which means it's probably doing very well. Maybe growth could be shaved off around 25 basis points is our estimate here at Bank of Baroda. So earlier we had a growth estimate of 7.4, 7.5. It will probably be 7.15 to 7.25. So what is this based on? We are assuming that there will be another 50 to 75 basis points increase in the repo rate. We've already had 40, so I can be talking of something in the region of 115 basis points on the upper limit. So we could be ending at 5.15, or we could probably be ending up at around 4.955%. So I think that's what the situation looks like. We are turning around in a very gradual manner. And my sense is that the reason as to why we again had this sudden concern on the external side. All the time we were talking of let's balance growth, let's balance inflation. But suddenly we we had this case of saying that there is something which is happening to the currency, and as what Dharmkirti has rightly mentioned, I think our forex reserves are falling. For how long can the RBI keep putting in $5 billion swap on a regular basis? I think the reserves have a finite limit. So I think that's why they thought that let's start off, and the timing was let's do it before the Federal Reserve again. The greater impact takes place. And I again go along with Dharmkirti that there's also this thing of saying that at some point of time we are answerable to the parliament, and then the parliament will say that why haven't you done anything? It's one thing to say that inflation has been beyond the control, but then as an MPC they're supposed to take some action. So I thought instead of pushing everything on in June, they've probably done 40 basis points right now, maybe another 25 or 50 basis points in June, and I think that will be the way we'll be going forward. Okay, thank you.
Thank you, Madanji. That I saw the article today that you studied the background of various periods when the rate increases take place, how that results in credit growth. So that is a good study which you have published today. So of course, now that's why I have to come to Mr. S.V. Shastri also, being a great banker. So one, sir, that the government fiscal deficit is projected this year for 6.4, and their central government borrowing is nearly around 15 lakh crores, apart from the state government. So one benefit the government all these years during this particularly COVID time, they were able to get on an average. I think first time it was maybe 5.5. Later I am not fully aware, but I think in the same range, and because they have to necessarily, RBI has been also managing this overall borrowing program without any much difficulty to the bank or the participant. Both the sides RBI has been managing. So in the light of that, how do you see with the current rate increase, how the RBI will manage the futuristic borrowing, and whether there may be likely that with the GST and other tax buoyancy, they may borrow also less, but the overall impact of inflation, how that RBI will, and they have to necessarily, the import bill going up, particularly oil. So your overall macro issues, sir, same continuing with both the economists, and how our even government securities portfolio or the bond portfolio, corporate bond portfolio, how are all these things going to shape up? That I would like to ask Shastri ji. Yes, ji.
Thank you, Dr. Narendra.
Sir.
Let me start with the inflation numbers first, and from where the economists have spoken and left. Inflation has continued to rise, that is one. And in the US also, it has touched a 40-year high in excess of 8%. So they have been reacting in a manner to curtail inflation, irrespective of the fact that whether growth will be hampered or not. So their first priority would be to have a grip on inflation, and which will lead to a slowdown in growth. And once they have control on inflation, they will start looking at growth or giving impetus to growth. In our case also, last 3-4 inflation numbers have been in excess of 6%, with the expectations of inflation going much higher have already been there. Like when the numbers are out tomorrow around this time, we should see a reading in the range of 7.25 or 7.5 as well. So therefore, in the last April MPC meeting, they had changed their stance from growth to containing inflation. So that, having said that, now the way they had a MPC meeting in between the scheduled meetings on 2nd and 4th of May, and thereafter announced a hike of 40 basis points in the rates. That has come as a surprise to the markets. Of course, the same day when the announcement was made at 2 o'clock in the afternoon, I was in the dealing room. So a couple of my traders, they said that because it is an announcement by the RBI governor, they had said that there would be a increase in the rate. At least 8 or 9 of my traders have said that there will be an increase in the rate, but of course the quantum was not mentioned, or whatever was mentioned by the team was being capped at 25 basis points. So now, having said that, the effects after that have been really bad for the government securities market, with the 10-year benchmark touching 7.47 or even higher, and then of course slightly cooled off at 7.21 today. There has been an impact on the forex as well. The rupee has depreciated 77.52 intraday, and then slight amount of correction is there. Of course, the RBI also appears to have changed the way they intervene, because without selling directly from the reserves or on the spot, they have been intervening in the futures as well as in the non-deliverable forwards. So all these things will have an impact until the currency stabilizes. At some point of time, you will not see inflows, because exporters will normally expect that, okay, let us wait for a day or two more and see whether I get a benefit of the rate. So once it stabilizes at some place, then yes, you will see some inflows as well. And also the importers who have been covering now, they could slightly slow down. And Dr. Narendra, your question on how the government borrowing and all will be happening. 14.31 lakh crores is the gross borrowing which is scheduled for this financial year. We have already seen a hike in the rates, and if you look at the impact of the rate action of 4th May, today's T-bill auction 1 year has come at 4.92 or 93, a full 100 basis points higher than what it was during the previous week. So that shows the direction or the market thinking that the near-term rates could go up much faster than what the markets expect or what the others are feeling. So overall, I think the government will have to, the RBI will have to come in with switch auctions or OMOs to give comfort to the market that they are there always, and the government borrowing program happens smoothly. GST collections at a record high, and hopefully should continue for two reasons. One, the pickup in economic activity, and a fair amount of compliance is also happening. Traders who are evading 50 crores or 100 crores are also being targeted. So that way, compliance is also improving. The benefit should accrue throughout the financial year. So this last one on the state government borrowings, the quantum, or as per the calendar, what was announced for Q1 and what the states have borrowed is far lower. This is because the center appears to have given some funds which were due to the states. Overall, the total quantum of borrowing by both by the center and the states could be slightly lower than what has been indicated during the budget. So with that, the rates likely to go up, and the borrowing program should smoothly go on. Thank you.
Thank you, sir. Really, that is practically what is happening today. And as he rightly said, both the short term and the long term bonds price have gone up. Now, that will also, I think, the corporate bond price also would have gone up. So that will increase the cost of borrowing for the corporate. And one, of course, issue coming later, whether the corporates will start the new investment, which I will cover later. Now, coming to Jayesh Mehtaji, that what's really happening globally? That is a very important, some of the country specific or the regulator specific. And I'm also a little surprised how the inflation level, like US for 200 or what you call 2%, they had gone to nearly 7.5, all that, and their 10-year yield also is going up. So how are they allowed that to sometime to get into the critical stage while later the US Fed rate started? So all the global factors and how that will have on emerging country like India, and even in the Forex and all we were talking. And like, the India has been a very big great center of Forex, FDI as well as portfolio investors. That has given a great liquidity to Indian market also. Even though today the retail investors and the foreign, our domestic financial institutions also have given great support. Now, example is LIC IPO itself got through, even though there have been slightly lacking interest by the foreign institutional investors. So in this scenario, some of the macroeconomic factors of the global thing and the emerging economy, particularly also later India. India, of course, we have covered, but I would like to have being your global view, sir. Jayesh Mehta ji. Jayesh. Madam Jayesh Mehta, you have done co-host, no?
Yeah.
He's there. See, Mehta Jayesh, you give him co-host. You are not done. Mehta Jayesh, you make him co-host.
Yeah, I got it. Got it.
Okay. Okay. You heard, no, Mehta?
Yes, absolutely.
Yeah.
Thank you, Narendra ji, for inviting. Okay, so before I go into global, I would just like to add what Joshi ji said and Madan ji said and Shastri ji said. I would like to give a little bit my take on this mid policy situation. I have a slightly different take. Of course, I agree with most of the point on the macro and the inflation side. But my thought process, and I completely agree with Madanji that I don't believe that behind the curve we are nowadays, using all global languages. And moment, you do one rate hike or one tightening, just like Fed dot plan, we start, economists start planning dot plan here, which is not even RBI's thinking, right? So, but my take on that is, if you really look at, February policy, we were very aggressive on our inflation forecast. But having said that, to be fair to RBI, none of the economists has said more than 5.5. So if RBI's forecast was 4.5, nobody said more than 5.5. And still it was therefore below the range. One thing which people have not noticed, they actually did the reverse repo rate, irrelevant in February policy. They tried to do that by, increasing the VRRR to a larger extent. And therefore, if you look at mathematically, if you lend for 14 days at 4%, and if you need to borrow for 4 days at 4 quarter or something, therefore your overnight cannot be less than 385. But somehow, everybody has to answer to their management and other things, so that, we have seen that in the bank also, right? You also question your guys that, okay, fine, if you're lending at 4, why are you borrowing at 4 quarter? So a lot of people, so first week of February after the policy, it remained overnight moved to 380.85, but then people started keeping surplus extra. They don't mind. Nobody questions you if you lose 60 basis point carry. So instead of lending at 4, you lend at 340, nobody questions you. But if you just borrow that, so that was one part. Now coming to the April policy, right? Of course, SDF was a requirement which they were looking for since demon time, right? Finally, it came through. So that was good part. They did change their trajectory. But again, to be fair, if you really look at the governor's own wording, right, the oil price, the war was just 10, 15 days, we were into that with 3-4 holidays. The oil price, crude price moved from 100 to 130, then again moved back to 100. It was, it would have been a knee-jerk reaction, but then they at least kept all their options open. I think by end of the month, that, by beginning of the May, there was quite certainty that this is going to last for a longer time. So if you really look at it in 10 days from the war, whether it will sustain at 130 or 100 or 90 or 150, nobody knew. So it was rather wait and watch. But looking at the way things have shaped up in last 1.5 months, people feel now that this is going to be a little bit long drawn, and therefore the averages will be higher, and therefore you need to do that. And as Sastriji said, with the gross borrowing, I always have this theory that you need that fourth buyer, right? So, when you have the supply of government bonds and state government bonds, you have banks, insurance companies, and provident fund buying, but you need that fourth buyer normally in a smaller thing, or when the markets are good, you have FPIs coming in, or otherwise RBI need to be the fourth buyer. Now, while you are raising rates for them to come out, maybe my feeling is they would actually do 40, 40 and 35. So 40 now in May, 40 in June, 35 in August. And therefore, then they get some respite coming back to the pre-COVID repo rate, which is 5.15. And that is what, that is that thought process. And then take it from there. Hopefully, things settle. We don't know where it settles. So that's one part. As far as globally is concerned, and we are also getting impacted. So while our bond market is very immune in a way, because we don't really have foreigners into it, but we have a OIS market, the overnight index swap market, which is very much linked with the foreigners. So if you really look at what it is pricing 1 year forward, it is pricing 7.5%. So therefore, the foreigners are pricing that repo rate would be to the tune of 7.5% 1 year, that is 23, 24, which of course, who knows? And I don't believe in that. But again, now coming back to their view and their thought, why they are thinking that way. Because if you really look at it, yes, Fed initially they'd say that this is, the inflation is transitory, which was also the feeling because a lot of global supply disruption had happened, things had changed, but the disruption didn't change away. So even if your COVID came down, you had disruption of other types, the lifestyle disruptions. Nowadays, I believe tech companies, if they have to hire somebody, they need to give at least minimum 2 days working from home. Otherwise, people don't join them. So people have changed their lifestyle preferences also globally. That's a challenge. And of course, China still under semi-lockdown. And of course, on top of it, we had the Ukraine thing. But even before Ukraine, people were pricing that now that till midterm, at least they will focus on inflation and not saying inflation is transitory. And therefore, Fed will have to do aggressively. And I think everybody knows that this inflation is not going to get mitigated by rate hike, to be honest, unless you really get the country, the economy to go into recession. And that's where the expectation by the foreigners, particularly when you are a foreigner international trader, you're trading every market, right? So you're not going to go and look at micro market India, like where we have a very good growth trajectory, everything. If Ukraine had not happened, right, everything was doing pretty good for us in India in terms of PLI, in terms of our tech business, all that was doing pretty well. So from that perspective, they are not going to look at micro markets. So when they think that Fed will have to go to the extent where it can hurt the economy, and therefore it will have to continue maybe going to 3.5% terminal rate for Fed. And in that situation, none of the emerging market can escape that situation. And they I call it sometimes they spray, right? So it's like, they will say, okay, fine, let's spray it across to all emerging market, right? With Brazil, India, Indonesia. So that's what it happens. And this is what the outcome is. And so while we sitting in India, we feel 1 year forward, everybody here on this panel and everybody will say 7.5, no chance, right? But for them, they say that, okay, fine, you think India at 7.5 is a great receive, but we see other markets, there are other great receives like Korea, right? But right now, because of the sentiment, and for them, it's like, they're not actually looking at micro markets, right? So that's where the challenge comes. Ultimately, I think our fundamentals will come through. So I think globally, the biggest challenge and the biggest thing is on the Fed and the pace of Fed. Plus, we haven't still seen the QT, right? The quantitative tightening. I think that is going to be hurting more than the rate hikes, right? So when the quantitative tightening happens, that's going to hurt more. And that's what all global investors are preparing for that. In terms of flows from FPIs, FDIs, FDI is still okay, but FPI flows, we have seen, you see most of the emerging markets, right? If you look at the US emerging market fund or something, they would have an allocation, say X number India, X number China, X number Indonesia, X number. So you have a leeway of 20-30% to cross that border. Just to give a numerical example, say assuming China weight is 45%, India weight is 10%, right? But the Chinese market have crashed so much, you need to rebalance. And how do you rebalance that? You're not going to add China, but you're going to reduce India, right? So from that perspective, and of course there is a redemption. If you look at US own investors, why would they go and look at when there's so much uncertainty in the world and look and put money into the emerging market? They would rather put it into US fixed income or US markets. And that's where we are seeing the dollar strengthening. And dollar is strengthening not only against us, it's strengthening against everything. You look at euro, you look at sterling pound, you look at JPY, right? It's the DXY is almost at the all lifetime high of 105, more or less, right? So from that perspective, we will see some retracement, but to that extent, it is more of a global US thing, which is where we all are getting impacted. And of course, as I said, like this inflation, can we really beat it through rate hikes? Difficult to say, but we'll have to go ahead with what people do. Hopefully, Fed also at some point of time, one of the thought process that they may actually stop tightening post September, but that will come to know only as and when. So next 6 months is till October is going to be very, very crucial. How things move, of course, there will be some blips in between, like today, the inflation, if it comes 8.1, there could be a relief or short covering rally happening in US. But from that perspective, I think for us, the biggest problem is how are we going to get our borrowing program done? While rate hike as well as OMO or Operation Twist, without OMO and Operation Twist, we cannot have this borrowing program completed. Even then the interest rate then just becomes a number. You need to have the demand supply matched, and that's going to be very challenging. So that's where I would say, even if Ukraine had not happened, even if the oil would not have gone so high, you could not have June, July, because first 2 months, April, May, you typically have leg demand, which is like Jan to March. There was not much of the issuance, so there is always typically extra demand. Either we reduce the borrowing program by 3 lakh, 4 lakh crore because of the great collection, or RBI has to come in. So that we will see as the time comes in. But yeah, the challenge is right now everything is run by what's happening in US. So that's where we are getting also impacted, and of course the global geopolitical.
Thank you, Jayesh. I will come back to you again later. So we have Harshil Suvarnkar. He is a fund manager. Of course, these particular current macroeconomic situation, we are already finding some major correction in the equity market, and also what you call the expectation of the bond investors have gone very high. So that is the point where we are seeing how the fund manager will view both the impact on these two markets. And another is fixed, fixed income, particularly the bank deposit interest rates are likely to go up. So the money which came to the equity market in a retailer investors buoyancy, or is there a chance that some of them will shift it to the bank deposit? Just today, State Bank of India increase in all band, and of course somewhere more than 90% also, 40 to 90 points. And so how are that situation, mutual fund? And I saw some April month flow has been slightly lower than the earlier month. So how are these things are also going to shape up? And one more thing is Indian budget 2020 to 23 has been prepared with keeping in view our 8 to 8.5% growth in view, and around nominal 11 point, or that is nominal growth. And it has projected inflation of around 3%. And where are we seeing the inflation? So similarly, the oil price, maximum maybe $80 to $90 per barrel. Now it is averaging 100, and if the 100 and plus remains, it will have an impact on GDP. That's where the RBI reduced to the GDP growth projection itself. So Suvarnkar, Harshil, how are you seeing all this macroeconomic aspect as a fund manager, and not necessarily relating to your fund house generally? And how are the the balancing of this impact can be managed, and the emerging futuristic issue. Because I have one, our ex-chairman of the corporation bank has written correctly that by through the what you call rate action only can we tame the inflation, or are we going to some sort of recession? That is also another issue. So can we have your views, Harshil?
Right, sir. So,
Yeah.
so like, my co-panelists have already highlighted that, RBI's rate actions have changed clearly market expectations. And as Jayesh pointed out that, OIS market itself is pricing in 250-300 basis points of rate hike from here in the next 1 year, which to our mind might seem a little absurd, because that's pretty much aggressive rate hike expectations that are there in the market. But given that there has been a sea change from where we were in February, that we were very dovish. From April, we said that we are accommodative with withdrawal of accommodation, and there has been an intermeeting high. The market has aligned itself, and I would like to call this event itself as the great reset within the fixed income market, that the fixed income market has reset higher with the expectation that RBI will go overboard and inflation will keep overshooting RBI's trajectory. So even if, let's say, tomorrow, like pointed out, then, if tomorrow's inflation is around 7.5 is already expected, but if we get inflation print of around 780, 790, market itself can reset higher by 25 basis points. But given that, the market itself is priced much higher. So, if you were to look at today's closing levels, your 4-year government security itself is at 693. Your 10-year bond, although maybe at 722, and 5-year bond would be somewhere closer to about 7%. So these are again semi-annual yields, and if you add STL combination, etc., the market itself has become much juicier for people to invest into. So with this great reset, most of the things that RBI would be doing, or let's say if RBI hikes rates by 50 to 75 basis points in June itself, because if one were to read the monetary policy, RBI used the word ultra accommodative for the first time. It said that it went into ultra accommodative mode on March 27, 2020, when there was a large reduction of 75 basis points, and then in May 22 it reduced by 40 basis points. So that 40 basis point has got reversed. With the reversal of 75 basis points, they will go back to a normal accommodative mode from ultra accommodative mode. So itself, people are pricing that RBI will move away from ultra accommodative, and then we'll see. But again, bond market being bond market, and all markets run faster than what everybody envisages, because of the intermeeting policy and how RBI has moved. Market has also reset its expectations much higher from RBI itself. So given that, where rates have become reset, which is pricing in most of the rate hikes that RBI will do, it is pricing in a terminal rate of around 7%. You're coming to your question that how fixed income markets are. Fixed income markets now look of course lucrative. We've seen some relief rally. We can see some sell-off pressure. So on the shorter end side, at least I would say that fixed income markets look attractive. On the longer end side, as highlighted, I think from the demand supply situation, where RBI has to manage the central government borrowing program itself, and if you were to count the growth in insurance companies, premium collection, and banks SLR requirement, there itself will be a shortfall of 3 lakh crores of demand in the market for sovereign securities. And with that demand supply, you can also see a long end of the curve, which is the 10-year bond itself getting repriced a little bit higher than here. So those dynamics, I believe that are still left to be priced in, and that can go higher. However, said that with this great reset, a lot of bank deposit money can potentially move to mutual funds, etc. Because where for if somebody is investing for 3 years itself, we have our target maturity funds within the industry, or the passive debt management index funds. So from FD, people can move over here, where itself a central government security of 3 years is yielding around 678, 4 years is yielding around 7%. So that makes it lucrative versus a bank deposit. So we can see some flight, but of course, bank deposit being its nature remains sticky with banks, but there can be some flows from banks to such kind of instruments where people can go in and lock in a higher kind of return. With that, why RBI would have, from a macroeconomic perspective, of course, if RBI saw that inflation is coming high, and they clearly say that sustained high inflation will hurt savings, investments, and output growth in our economy. So which is the measure? So basically they are saying that they have been pro growth by trying to control inflationary expectations in the economy, and going further, if we are expecting, and of course it is expected that inflation continues to be on the higher side, where we right now expectation for tomorrow's print is around 7.5, 760, and then going ahead also we are not seeing that we will go below 6%, and RBI will have to face the parliament, because 3 quarters of continuous 6% plus will lead to RBI answering the parliament. So inflation of course will be higher. So from a budget perspective, RBI will not look at shying away from raising rates. So government will, in some sense, earlier had, from a budgeting perspective, had given some projections which were very conservative on the revenue side. But if you see, because of the Russia-Ukraine war, they have had to take in a lot of the fertilizer increase which has happened globally. So because of the fertilizer subsidy increase and other food programs that they will have to do, so the conservatism will go, and they might end up doing the same government borrowing program. But again, as I said, that there seems to be a 3 lakh crore kind of a demand supply gap between what we project that will be required versus there. So there, that seems to be an issue. So the entire conservative budget on the revenue side seems to be eaten out by the additional subsidies that the government will have to consummate. And from a, of course, from a projection perspective, where RBI had projected the inflation, at lower at about 4.5%, that of course has went out of the whack, with now crude being about 100. So inflation, in our view, should remain about 6% for the full year on an average basis. So that's the broad view on inflation.
Thank you, Harshil. And really, from your point of view, catching the higher yield curve in terms of the fresh investment is really good for retail investors also. And RBI wants the retailing of government securities to pick up, and they are also opened up directly. You can get into the RBI in terms of that, and there is a platform is there, and that has been, I think, high net worth individuals or some of the family houses and all must be getting into that. And of course, corporate also would have been on a larger participation in the treasury in relation to government bond. Only, of course, the one area that we have been finding that the private sector investment where to start, and some green shoots were seen. And at that moment of time, their cost of capital into because of this particular rate, if they are borrowing, that may slightly go up. So, and without the private sector participation, the government program of large infrastructure project, particularly, and even for asset monetization, of course, there may not be fresh investment, but there is a private sector has to participate. So they need the money also. So that is the one we need to have greater private sector, for which the last that whatever period was an excellent period. Unfortunately, the demand was lacking. Capacity utilization was lacking. So that has not really picked up. So now I go to Mr. Madan, that he made a one today study, and I want to ask him that one is whether the credit growth, which for one quarter it showed double digit, later again came to 8%. And the more pronounced credit growth were visible in the private, primary, what you call personal segment, as well as the MSME, and the corporate sector also, the fag end has shown good growth in the wholesale lending. So now, how are these credit growth is likely to shape up? And because it's a projection with the rate action, and whether that private sector investment also likely to start, and how do you see that is going to add to the GDP growth of India? Madan?
In my
Yeah.
opinion, there will definitely be a slowdown in growth and credit compared to what we felt in the month of March. So actually, before this Ukraine crisis started, we had thought that bank credit growth will be more in the region of around 12%. I think it'll probably get moderated to something around 11.5%. Now, the reason is that, as you have mentioned, that I don't expect the private sector investment cycle to pick up in a broad-based manner. We'll definitely see investment taking place in certain sectors related to infrastructure where the government is going strong in terms of capex. But if you're looking at the basic problem in India is consumption. I think this is a problem which was there before the pandemic. And I think it goes back to job creation, income generation, and inequality. I think all these issues were there very much earlier. And I think that is being exacerbated now and with high inflation. Because today when we're talking of high inflation, I think it will come in the way of all our expenditures. Maybe we who are better off will probably still carry on as normal. But I think if you look at the middle class, the lower income groups, I think they're going to get affected, which will affect their discretionary consumption. So that's why I'm not too gung-ho about a broad-based improvement in capacity utilization, leading to investment taking place, again, in a wide manner. And therefore, to my mind, there would probably still be a case of saying that we will have enough funds with the banks, which could be going in for supporting the government borrowing program, primarily because of the reason that investment is not going to take off the way in which we expect. So I think it all goes back to consumption. I'd say demand is the important part. And I think the finance minister also mentioned that consumption needs to pick up this year. That's going to be pushed back significantly on account of inflation. And now that we have the higher interest rates, I think it will come in the way of the MSMEs, because the larger companies anyway will still be able to borrow at fine rates. Like if you're talking of a cement company or a steel company, these industries doing very well. I think interest rates going up even by, say, 50, 100 basis points is not going to affect them. Because if you look at the interest cost to turnover, it's on 3 to 5% on an average basis. But if you look at the MSMEs, they're the ones who are going to get squeezed a lot. So therefore, I think there will be a lot of tempering of growth on that side.
Yes, Madan, you have been always mentioning that the bottom of the pyramid also needs to be benefited with the GDP growth and all. And our per capita income, even at I think around $2,000 US. So if India has to catch up 5 trillion economy, India's GDP has to grow at least 8.5 to 9%. So this would have come, but due to this current macro, whatever that inflation going up, that will slightly get further affected. So it will be elongated. So now I will turn into Mr. Dharmakirti Joshi. That how are our what you call export market? If at all he has some views on that. And India had a 420 billion US dollars of export, and but still, as it had increased in the export to the GDP, and other side, of course, now import bills also going very high. Even the last year import bill, and now with these food related oil and all import, plus the what you call the natural gas and oil per se. With that, our import bill definitely will go up. So how are our current account deficit, balance of payment position? And the RBI had around 18 months of import cover. And now it has come to less than 12%. So what is the adequacy of Forex reserves? Is there any benchmark for that? That is also. So if at all, Dharmakirti, can you cover some of these areas?
Yeah, sure.
Yeah.
I think as far as the exports are concerned, I think we had an exceptionally good run in 21-22. I think one of the prime reasons was that the global economy was doing very well. I think global growth was 6% over a week base. And now as we move deeper into 22, what we find is global growth is getting continuously marked down, whether it is China or it is US or it is Europe. I think the growth revisions, subsequent growth revisions are only downwards. And I think the tighter monetary policy actually also raises the specter of recession, I think, in some of these
100 basis IMF, I think IMF or what they have projected downwards. more than
Yeah.
100 basis.
I think we expect further downgrades in growth. I think particularly China is on a weak spot. So now there are two factors at a very broad level which will impact our exports. I think one is what happens to the global growth, which is of course slowing down. Second is exchange rate. So there is some support from the exchange rate, but of the two factors, the most dominant factor is global growth. So I would expect exports to weaken. Imports are very sticky in nature. I think you can't, you have to import oil. I think you have to import coal. So there will be a pressure, I think, on imports. So as a result, the current account deficit would rise, and I think would start getting closer to 3% of GDP, which still is a better position than 2013. I think it was close to 5%. So so there is clearly a pressure on the foreign, on current account deficit, and you will require more resources to fund that. Now coming to the other part, which was, I think, can you repeat that? Sorry, I think I missed the second part.
The forex cover part.
Yeah,
Forex
sure.
Yeah.
Yeah, I think now the forex cover is like an insurance, and I think it depends. And I think the adequacy is typically measured through various rules, I think. And as you rightly said, the forex cover has come down, but it is still quite adequate. I mean, 12 months is pretty decent. I mean, it's a reasonably good. So it's like an insurance, and you have to, I think, having a good forex cover, particularly in such volatile times, is extremely good. But you can't rely on the forex cover alone to curb volatility in the forex market, for instance. That's why I said earlier, as I said earlier, the RBI had to tighten. So I think so both the instruments of intervention as well as monetary tightening, I think, will be helpful in curbing the capital outflow. Now, what happens, whether it will be adequate or not, very hard to say. These are very uncertain times, and I think to be very clear, so anything that you say, the confidence interval around that forecast will be very wide. So all I would say is that this is a period of turmoil that is going on, and we have to be very careful. And policy in this environment has to be data driven. So I think as it evolves, so it's very hard for me to predict how much volatility will play out. But going by what is happening currently, I think on various fronts, I think inflation is high. There is a war going on. There are supply chain issues coming because of China's COVID policy. China itself is slowing down. So I think too many moving parts. And I think in this environment, I think we'll have to, and Fed is going to be very aggressive with rate hikes, because they're actually, the US domestic demand is still quite strong. So I think unlike us, the domestic demand is also contributing to inflation. The growth is getting revised down because of the external factors. I mean, the terms of trade shock that they are getting. So that is what is leading to the job market, and demand is very strong. So Fed is going to address that, and it's going to be fairly aggressive. So in this environment, I think I would certainly, I think over the whatever horizon I have, let's say 2 to 3 months, I would say that it will be extremely volatile period. And I think the risks are clearly tilted downwards for everything.
Yeah. So thank you, Dharmesh Kirtiji. And see, we had the budget 2022-23 also, and both of you and Madan were their part. So some of your observation, even that time you have given particular, like you also given 3 areas of risk. One was the US Fed action, and another is the inflationary coming in the various, like that 3-4 areas you have given. So I am seeing with that risk factor which you have given, I am not immediately having assessed, that really shaped up later. So it was even in budget time, it was expected that this situation is likely to happen. So one of my participant, he's also a treasurer in a foreign bank. He has asked that this overall current situation is supply-led factors, both globally and domestically on account of the global factors. So how the mere RBI can play? What is the role by the government? So this, I think now I ask Jayesh Mehta ji, what can be the role by the government? One. Second is the one, as a you have been experienced person, this fiscal deficit, that our government said that they would like to achieve 4.5 by 2024-25. Now the current is around 6.4. So this year also, is the government may be able to manage within that, definitely, but that has been a slightly negative from some of the rating, or what I call external outlook, that the fiscal deficit of India and the overall borrowing also maybe 88% of the GDP. So what are your views on that aspect?
There are two
Jayesh?
parts.
Yeah,
There are
two parts. Yeah.
Right. One is my own personal take, which I firmly believe that, we can monetary policy, right now it's all supply supply thing, which is really dragging up the inflation, imported inflation for us. And for us, being the largest oil consumer, importer, that matters a lot, right? So jokingly, I do say that up to $110, $115 is what monetary policy can manage. Beyond that, the fiscal has to manage it. And fiscal has to manage it not by expanding fiscal, by reducing their expenses, and therefore using that expense to subsidize, or not subsidize, I would say reduce the tax on fuel and other stuff. So that's my personal view. But the world does not work that way. I think all central banks will have to act when the inflation is a problem, and therefore, even though it's they also realize that it's a supply side thing, but at the margin it may help, and therefore they need to be seen doing that action, and that's what the worry is, right? So it's till the time Fed continues doing it. Once Fed goes into that old mode of transitory inflation, or starts saying that it's a supply side issue, and therefore we cannot really harm the GDP of that's the time the other banks will change. But it's not that we can stand alone, say that okay, fine, it's a imported inflation, and therefore monetary policy can do very little. We all know it can do very little, but we'll have to still be acting on it, and that's what we will continue seeing it happen. So hopefully, as I said, like right now we can only say hope, right? So we don't know how the outcome is going to come out, whether it's going to last for a long-lasting year, whether the oil is 90 or 190 in next 6 months, who knows, right? So from that perspective, it's very difficult. It's watch and wait, but at the same time, we have to keep on expecting till the things changes, that central banks, not only India, because India is just what we need to follow what's happening in US and other parts of the world, right? So we can't say that, we are domesticated economy and therefore it's not our problem, it's not our demand which is creating inflation, but I think we have to play that on margin. That, as I said, like my personal view, beyond a point, fiscal will have to play a role. Let's see how that goes.
Yeah. That is, of course, as earlier also said, both the Reserve Bank along with the government, they took a lot of measures to control or manage the downturn in the economy due to the COVID, and the Atmanirbhar Bharat, as well as the RBI around 12 lakh crores, and that altogether around 29 lakh crores, and also very structural reforms. And I think our government will continue to do on the structural reforms, so that there are a lot of infrastructure or other projects which are including PLI scheme, manufacturing hub and all that, where the government will be inviting foreign investment, that will continue to give support to Indian economy. The FDI, it was expected by one report that it can be around 120 to 160 billion US dollars. So that will naturally help. So we have to see that can reduce the government borrowing also in a way that last year also by some of the external what you call items bringing to the budget, making a transparent budget, the fiscal deficit was taken to higher level. And one very important point was the tax to GDP was around 11.1. The number one it has increased. So this trend, if it is witnessed, maybe as he rightly said, as Shastri mentioned, it may be due to the compliance level also. If that trend is maintained, I am sure our base of what you call tax compliance should go up. So now coming to our S.V. Shastri again, sub, that that the overall banking sector plays a very important role in the scheme of things. Whenever the country faces difficulty, or even in terms of responding to the government requirements, responding to the RBI measures, and currently the banking sector and the financial sector is in a very much better shape with the lot of provision coverage and reducing the NPA. So how do you see that currently, or whether the banks will really poised? And with the rate increase, there are earlier some risk-adjusted return on their lending was slightly thought that it can be because there were report also. SBI economists made a report that we are simply sometimes lending short-term or whatever at a very such a low rate. Now that all will get corrected. So how are these things going to shape up in the banking and the other financial sector, and also on the credit growth and overall the scenario of our the performance of the bank, sir?
Okay.
Yeah, sir. Yes, sir.
Many like I may not be having the numbers, but I think
No, not quite, sir. Generally, sir.
Not that way, but the
Yeah.
economists on the panel, they will also watch for it. Many of the banks or in the banking industry, the portfolio of loans which is linked to the external benchmark or the floating rate loans, the percentage is much higher than what it was 3, 4, or 5 years ago. So now when such a thing happens, as the rate hike has happened 40 basis points, I think the same day 2 or 3 banks had raised the repo rate linked borrowing rates. So then even for those which are on the external benchmark lending rates, those also will get repriced. So that should not be a problem at all, because bulk of the lendings are now happening to the external benchmark linked rates, EBLR. So I don't see much of a problem. Only thing is the pace of credit growth, which was lowest during the year ended 31st March 21, 5.63%. That has almost touched double-digit growth or somewhere near abouts in the last year ended 31st March 22. This year should generally not be different from what it was during the previous year. So despite the rates being hiked, the banks will raise the deposit rates. A couple of them have already done. And then the lending rates will automatically rise. And of course, this will again be reset if a rate action happens on the 6th or 8th of June and as we move forward. So that way the bank's net interest income will be protected, or there could be a bit of lag. But then we don't see the banking industry being very much affected by these rate hikes. That's number one. Yes. Number two, if at all there are going to be delinquencies and all, we have enough provision coverage done. And as we look at the numbers for the banks which are declaring the results, they project a healthy picture. Now, how far is it going to affect the industry and how it is going to be in the coming quarters? That needs to be seen. So that will be more on a wait and watch approach. And if the banks are required to make provisions, we will have to do it.
Thank you, sir. As rightly pointed out, that the banks have been having a proactive provisioning methodology, and they have almost 80% above. Few of them have already achieved the provision coverage. And even in some other restructured cases, if you are likely the predictive analysis looking little no shaky, I think the provision would have been made, because particularly the restructured portfolio with the increase in the interest rate, we have to little sensitize and make a sensitive study. And also the private, particularly housing loan, now if it is a floating, their interest rates are likely to go up. Other side, inflation being there, how is EMI paying capacity? That has to be seen. But to that extent, in the earlier also, even during COVID, the expected default ratio never happened. It was all under control. So that extent, our borrowers are also quite aware of how to face the rising situation. Now, on a last, on Harshil, that is there a, for the this type of like banks portfolio on, of course, our Shastri Sahab also can, some of the portfolio will have MTM losses. And whether in the Indian context, in the fixed income also, are we very active in the what you call derivative instruments or hedging instruments? And how are they, maybe as a fund manager, your other part of that, no, they may be also taking some steps. Is there mutual funds are also active in this market to hedge that certain return, all that? I would, if at all, you would have some view on that. This is the last point of our webinar, and later a few questions from the participant, if it is so possible, I will ask. Yeah.
Right. So I'll answer the second part first, where on the interest rate derivatives market. So on the interest rate derivatives market, we have a very active OIS market, which has participants which are offshore and both onshore. Onshore side, banks, mutual funds, insurance companies are active. Insurance companies lately have also been active on these FRAs, which is the forward rate agreements. So, interest rate swaps are very actively used by all fund managers and bankers and traders. Over here, the liquidity is also very decent because of standardized trades, because you have 1 year, 2 year, 3 year, 4 year. Whereas, if let's say I like interest rates right now, and I think that interest rates can go down. And if I were to buy, let's say, a NABARD, PFC, REC paper, I have to go in the market, scout for it, because it's primarily an OTC market, unlike the GSIC market. I can just go and receive OIS while I get these papers from these market. And the OIS is very liquid. So you have a very narrow bid ask over there. So there is not enough, not very wide bid ask over there. So it's a very liquid market, which is used by all of us. Banks also use it very actively for their ALM purposes. As a mutual fund, let's say if I want to protect my portfolio, let's say if RBI has raised rates and I think that there is a risk to it, I could have hedged my fixed rate bond portfolio by converting them into floating by paying fixed OIS, where I could have, desensitized my portfolio to these interest rate risk that I'm facing in the portfolio. So it's very actively used across the industry, across mutual funds, and banks use it. Banks, from a overall perspective, yes, banks investment portfolio, at least from the available for sale portfolio, will have an issue, or a STM portfolio. From accounting perspective, I don't know if they'll be able to have the MTM, but particularly on the asset side also, as Shastri sir mentioned, that, your rates on the loan side will also increase, because there is a larger proportion of market linked benchmarks, or repo or T-bill. All of them have already priced higher. So because of that, the loan portfolio also gets priced higher. So in some sense, banks will not have a very large impact because of it. Of course, the investment book gets impacted to some extent, and that performance will get hit in this quarter, but it's not going to be so large that, banks will report very awful numbers in the market. But that's, I think, should be okay enough. And plus it increases the bank's accrual, right? If you're taking a loss right now, the accrual from next quarter. So over a period of 1 year, I think the effect on the accounting books also gets streamlined over there.
So yeah, please continue. Yeah.
On CDS markets, there is active discussion right now. We are also a part of the committee on CDS markets, which we are discussing, and how things should happen between RBI, SEBI, etc. Once that comes in, it will also be very interesting to see in our markets as to how we can actually hedge our credit risk also. So
Very
right now, interest rate risk hedging is very easy in our markets and very actively used. Credit risk is something what our regulators are looking and is hoped to be launched soon.
Thank you. Thank you. That is very important because all these markets getting developed will act as the hedging mechanism, and it will really help. And as you said that whatever MTM losses and all are quite manageable. It is not a very great issue. One more, maybe the RBI last time, the held to maturity also, they have increased the percentage. So in the current scenario, when wherever there is a lot of tools, what I'm telling, RBI will do that. No, there are a lot of tools, conventional, unconventional at the RBI to manage whatever emerging situation and see that the balance of risk is maintained in a way that it doesn't affect the market overall participant, and at the same time that is will be a reasonable thing. We had quite a lot of professors and some of the leading bankers, and the audience number may be looking little, but all are serious. They had the opportunity to hear from this very learned and experienced panelist, and another maximum 5 to 10 minutes maximum. I would like any one of them, if they would like to ask or give any added their own views on the subject, I would welcome, including, of course, Samamurthy is there, Ajit Mairpadi is there, there are Mr. Kannan is there, there are a lot of professors are also there, even like today. So, like Radha Raghuram Patruni, that is, she's from the university, Dr. Radha Sharma, DS Tripathi, there are, or Pankaj Trivedi was also there earlier. So, few of them would have gone back. So, and Rajendra Gandatra is there. So, I request a few of them, if they are just can mention that you want to ask, then immediately I will ask the backup to allow you. Anybody? Madam, you have a look at who are willing for
sir.
some. Yeah.
You can raise your hand also. You can unmute yourself.
Yeah. Rajendra Di or anybody would like to ask question? Kannan?
No, sir, I have only one observation.
Yeah, please.
Not a question.
Yeah.
Like Mr. Mehta said, it is all about it is all about supply chain.
Yeah.
So monetary policy's role in increasing interest rates, actually it is only a signal to the world. Because last year when every central bank was raising interest rates, RBI was not raising interest rates. So the signal was that RBI was not reactive, or it's not reacting, which all FII money, why it went away was because we are not raising interest rates. So by just raising interest rates, we are signaling to the world that we are also in line with what others are thinking. Like Mr. Mehta also said that if you look at USA, they are factoring in a very high interest rate increase in India, even though we all don't expect that. But to be in line with what is happening around the world, we need to increase the rates, whether it is going to have an effect on inflation or not, but it will signal to the world. And one more thing is that all these FPI inflows, they are based on interest rate movements across the countries. So my only observation is that even though there may not be a requirement to increase the interest rate, RBI has to do this with a view to ensure that we get FPI inflows. That's all. Thank you.
So what is Jayesh, you have any take on that, or that is you agree?
No, I agree. My only difference, on the traditional side, we do get, protecting the currency by interest rate. But if you really look at it, our FPIs are more equity players. We don't have, unlike other countries, debt equity guys. So from that perspective, raising rates does not still get you back the equity flow, but definitely the perception do change that, yes, they are also looking at inflation and trying to fight it. Of course, one take there is last year when people were raising, we were still within our range. So basically the crude price has really kind of, dampen our growth, or maybe the inflation situation has changed for us, particularly after Ukraine in a dramatic way.
Thank you. So now, Rajendra ji, what is your take on that? And Anuj Bhargava is there. He's one of the very management expert. So he's also raised one issue he was mentioning before Rajendra ji, that Anuj, what he wants to say, why do we have a same rate of interest to all customers according to the risk weights and other things? Of course, banks charge premium. Real estate is a very sensitive sector. Why not we increase the rate? And manufacturing, why not we give a lower rate? And particularly because India wants to go for manufacturing hub, and even for MSME also. Of course, that within the range of, after arriving at the base rate, within the range of 100 to 400, the bank changes the rate, and particularly by seeing the external rating. So, but Madanji, anything on this area? Mr. Anuj, you would like to ask, or I will ask? I asked already. Okay, no?
If you have, I can, if you want, I can clarify.
Yeah,
So essentially, my premise comes from the fact that when a patient falls sick, you treat each patient differently. The same is the case with every single borrower. There is a different case. There is a different, feasibility of his turnaround, his costing, the industry he is in. So why not apply differential rates or permit differential rates for different borrowers within a band, because it has to be a band. So things like property, which cause all-round inflation, you can, or even autos to an extent, you can, to control petrol, you can have a higher rate of interest. I'm not saying do this on real estate or petrol. I'm just saying the government can desire what it wants and RBI can categorize that. That's all.
Yeah, Anuji, that one before he answers also, banks, Reserve Bank increases the risk weights and the loan to value ratio also by correspondingly seeing which are the sensitive sectors. So now, Madan Sahab, you would like to answer?
Actually, I'm not into giving loans. I'm an economist, but my understanding is that the pricing is done based on the credit worthiness. So it doesn't depend upon the sector. So if you are a AAA, AA, depending upon an external rating agency or the internal scale which banks have, I think Mr. Shastri will probably, and I think Narendra ji, you yourself will be in a better position to answer this than any economist. But I think it goes on the basis. So it is variable, but it depends upon your credit worthiness. It cannot be supporting any particular sector. It goes on that.
Yes. S.V. Shastri would like to answer because he's a great banker.
What Madanji said, I concur with that. You have the external ratings and also the internal ratings. So once the pricing is reviewed based on the internal ratings, so there is always a scope, or you fit them into a band, and if they move up or down, the pricing gets adjusted. Of course, even within this pricing band, there are discretionary powers for various committees. So that adequately addresses these concerns. And then what rate a MSME customer gets and a corporate who is in the 50 crore or 100 crore bucket, what rate that corporate gets will be different, depending on, of course, the risk perception we have, the bankers have, and also the external ratings.
Thank you, S.V. Shastri ji. So, Rajendra ji,
This point, in fact, I would solicit the bankers' observation on this. Just now we were talking of the interest rates are charged, capturing the risk premium. Perfectly okay. But what happens, if some company goes through a temporary distress, the rating comes down, and at a point of time when such company needs a certain relief, because the rating came down, the rate of interest goes up, and it's a double whammy. It's a hit. Okay, if I'm a bondholder, and if I'm not doing the investing company isn't doing well, if the risk profile deteriorates, the yield goes up. I get a lower price in the market, but the investing company is not impacted. But here, if a banker changes this rate simply because its risk has gone up, it's a double whammy. I think something needs to be done about it. I've seen people suffering because of that. probably in that case, some right of recompense can be there. But at that point of time, if we do not come to his rescue, I'm not saying you do that CDR kind, etc. CDR was less said the better about those things. This is one point I would like reaction. Another thing is, we've been talking of the nominal interest rates rising consistent with the inflation. How about real interest rates? I feel that this time around, we have had the lowest kind of a real interest rates. I want the economists to enlighten me on this.
Yeah. This is the really good, sometimes we were going in the negative interest rate. And but for the growth factor, we have to keep that rate low. So the real interest matters always. So Dharmakirti ji, if you are able to answer this.
Sorry, I think there's some here. I couldn't hear the question properly.
So what he's asking, we are with the one is nominal interest rate and the whatever rate of what you call repo rate and all, and through the inflation adjusted rate is the real rate.
That's
so
right.
How are the real rate returned to our investors and all? How are they are monitored? And because sometimes we had a negative rate also.
We still have a negative policy rate. I think inflation is inflation currently, and expected inflation is above the repo rate. So there is a negative policy rate, and this scenario has played out since the pandemic struck. Before that, I think the repo rate, the real repo rate, used to be positive for 4 to 5 years, I think, and many people believe that monetary policy was excessively tight during that period. So now what is going to happen is, I think the deputy governor in the last press conference had said that we are gradually going to move towards positive policy rates. I think and what that means is that the savers will get a better return gradually, and for borrowers it will become more expensive. I think that's the direction in which we are moving.
Just to add to this, I think when Dr. Raghuram Rajan was the governor, he had mentioned saying that we need to have a real interest rate of 1 to 1.5%.
That's it.
Now, frankly, I believe that India is an economy which will always have inflation in the region of 5 to 6%. So just think of what should be the ideal repo rate to give this 1.5%. According to me, this MPC going in for 4% was a sham. I don't know how they arrived at 4%, because the time when we went in for the MPC, my simple calculation, just go back to see the last 10 years, 8 out of 10 years, India had inflation above 5%. So I'm sure there were certain nice models which showed that 4% was desirable. But I think the Indian economy requires an inflation of 5 to 6% to also give an incentive to producers to produce. But anyway, given this 1.5%, I think if inflation is going to remain at 5 to 6%, I don't know what rate the repo rate. I'm sure all you entrepreneurs who want to invest will keep saying that they're being killed with interest rates going up. I'm very happy with the positive real interest rate, because I'm nearing retirement and my deposits will get a higher interest. I'm very glad about it. But I'm sure from the business of my bank, I would like everybody will say that we need to bring lower interest rates, otherwise enterprise will suffer, investment will suffer. We started off our discussion also on these lines.
Okay, thank you very much. One of the participants also said that this inflation is imported inflation. That is naturally, there is a part of that is imported inflation only. So I am very happy that with a very, what you call, high level of discussion, very critical discussion, and there is a variance in some of the opinions also. We had quite a lot of this 1.5 hours we spent very well, and this particular recording already live in the YouTube, and also it will be uploaded to social media, LinkedIn and all. And I've been seeing that there has been quite a lot of people going through that. So in the industry and the market participant and others, your considered opinion on the very relevant and very topical subject will be very useful to all of them. I profusely thank all our panelists for sparing their time and be with this particular webinar. I also thank all the valued participants for their continued and overwhelming support. I also thank our A1 Logistics who give this what you call Zoom service and other backup service. So thank you very much. Good evening to all of you, and we'll see in the future also your support. Thank you.
Thank you.
Thank you. See you. Madam, you can take one photograph of all the parts. Of course, you would have seen I taken. Anyway. I took one photograph because
Yes.
all you were being on the line. I think some just left. Anyway, I have taken. You would have also have recorded photograph